Thank you.
Thanks, Elema. Welcome, everybody. It's great to see so many agents of impact for call number 42. Those of you who've been here before know that now's the time to start introducing yourselves on the chat to each other with what you're up to, where you're from, what you're thinking about. This call is the rise of alternatives to venture capital, as they say on the airplane, if you're not on the right plane, we've been calling it all week, startup capital for the rest of us. Dennis, come in, Dennis Price, has been covering this for us. And then Dennis, why don't you introduce our guests, and then we'll jump in and with a little intro.
Hi everyone, welcome, and welcome to our guest, Kim Folsom of Founders First Capital. Hi, Kim.
Hi there.
Kim is Founder First is San Diego based, has deployed at least roughly $2 million in revenue-based finance, and is one of the VC alternatives we'll be discussing today. Kim is a multi-time entrepreneur herself, has been an author in Impact Alpha and on the podcast, and now on the call. Welcome, Kim.
Cool. Good to see you. Good to be here. Thank you.
And Jonny Price of Wefunder. Welcome.
Thanks. Good to be here.
Jonny is vice president of Wefunder, one of the leading regulation crowdfunding sites. Although Jonny's got a new term for that. Earlier, Jonny had founded Kiva US, so has a unique view on alternative startup capital in communities across the country. So welcome, Jonny.
And we also have a number of ringers and special guests who come on and help broaden out the conversation. But Dennis, you've been digging in on this alt capital. Just set it up for us. What's the sort of broadest situational analysis?
Well, I mean, we were talking about this morning. New business starts in the US are at an all-time high. That reverses a decades-long entrepreneurship slump. Something like 5 million new businesses were launched in the US last year. Women are leading the way. Black women are leading the women. Immigrants are starting a record number of firms. Of course, many of them are sole proprietors, but many are hiring, and unemployment is low. Wages are up. Prices are also up because of demand, but entrepreneurs are sort of rising to supply that demand. But yet, venture capital and commercial banks are only backing about 20% of new businesses in this country. So that leaves about 80% of businesses that may be looking for other types of capital. So that's not a niche market.
Yeah, let me just pause and say, it's kind of a counter narrative to what we're hearing in the sort of the headlines. I mean, the businesses are starting up and finding customer demand. There's a kind of a disruption of patterns, as you said, of entrepreneurship and other things. And there's now like a whole set of borrowers and crowdfunders that we'll hear about. So I just want to sort of put a marker down that this is about sort of nurturing a whole kind of bottom-up revival of entrepreneurship that is really quite extraordinary, and what the mechanisms are to make that sort of trend stick, as it were. And just to this is you. So
we're going to jump in. I mean, just to frame up discussion, two other questions we've been thinking about is, if the new business demand is more diverse, how do you make the funding mechanisms similarly diverse and accessible when historically they haven't been? And if this is all such a good idea, why isn't it much bigger than it already is? And so let's bring in Kim, who has pioneered and developed and is in the market with one of these mechanisms. Kim, what do you think? Is the opportunity as big as we think it is?
Oh, most definitely. And but the thing, what do they say? It's the alternative of insanity. You can't keep doing the same things and thinking that you're going to get different results. So the reality is that it requires a different playbook to be able to fund this group of people who, while, as of late, it's become much more pronounced about the growing number of businesses led by women and people of color. This actual thing has been going on for a couple of decades. And just with, a number of things between the pandemic, the Black Lives Matters movement, the unfortunate death of George Floyd, all of this has become much more visible to the, mainstream financial marketplace. But this wave is going to continue.
Go ahead.
Sorry, go ahead, David.
No, I was just going to ask, just give us the context a little bit of who your borrowers are, what kinds of businesses, what are we talking about here in terms of this demand?
Sure. So the typical borrowers that we work with are what we call the mainstream companies. So these folks are not aspiring to be the next Facebook. They may be service, light manufacturing, type of businesses. That's specifically our sweet spot. But and we focus on those businesses that are already revenue generating. But the different elements is that there generally has been two vehicles: traditional debt, which either you get through traditional banks or CDFIs, or there's the other element, which is venture capital or equity capital. And on the debt side, generally, it's so much about the individual's personal financial credit profile for that to work. So if you don't have great finances or a house to pledge against it, it's difficult to get access to six figures of capital. And then if you compare, in prior big booms, others like be it, McDonald's, a lot of the hoteliers, if you look at their launching, many of them got access to $100,000, and that was the key capital that built the McDonald's and the Hiltons and all of these great mainstream businesses. Well, that's the same approximate amount of capital, 100 to 250,000, that needs to be unlocked for these diverse founders. But in the current capital playbook, that's not been available to them if you don't happen to have a house that has $250,000 in equity to unlock. And so one of the methods that we use at Founders is revenue-based financing, which is a much more flexible source of funding that doesn't rely on the individual's personal financial credit. It looks at the strength of the business, one, and the cash flows associated with that. And then the other piece that's associated with that, in order to assess the risk associated with that, is a bespoke underwriting method, which is different than the traditional 5 Cs that looks at the FICO score and also real estate assets to pledge as collateral.
Could you say a bit more about how it works in terms of repayments and why you think it works for this broader set of businesses and founders?
Sure. So revenue-based financing is it really is not new. It's just that the innovation is applying it to this underserved market. But it has been used, for centuries in the entertainment area. You look at movies and plays and those types of things that someone commits capital to allow you to produce a movie or something like that, and then they get paid back as a royalty stream, as it's consumed, and basically that royalty stream is paid back in a multiple. It could be 1.5, 2x, 3x, 5x, 10x. So many plays on major theaters, Broadway, movies. That's how they've been financed for decades. And then it was also used in the energy and gas industry to finance, putting wells in place, and then with the distribution of that oil or energy, it's a royalty stream that pays back the investor. And so the same thing for these businesses that are revenue generating, they have strong revenues, and there's a cap that's paid back, so they get a certain amount of capital, they pay this back. I want to share with the difference between revenue-based financing and some other types of financing that are calling themselves revenue-based financing is the payments are made monthly. But the royalty allows for the flexibility that happens for these borrowers that, less than $10 million, you're going to have these ups and down swings because that's the nature of them stabilizing themselves. And as you have that flexibility, 1 month you may pay one payment based on your actual revenues, and the next month you have another payment based on the actual revenues. The other element is that it aligns the interests with the investor and the borrower, because you're both paid when cash flows come in, not just based on taking cash, regardless of whether or not cash flows happen. So that's where the bespoke method is important to that element. And unlike equity, where you have to have a major liquidity event at some time in the future, you have this ongoing kind of, monthly liquidity pieces happening based on revenues coming in. And the inherent flexibility and nature of this capital allows for this ups and down rises that happen with small business. Like, for example, during the pandemic, for everyone, the second quarter of 2020 was a really challenging quarter. And for traditional debt, a lot of them had to either do forbearance or deferment because there was lower cash than what was the planned payment. There's the automated flexibility that's added into this method of financing to weather those ups and downs.
So is the argument is both that it helps the business literally stay in business, and then the other argument is that it broadens the aperture of companies that can get financing in the first place by changing the underwriting. And so why, I guess this is Dennis's question at the beginning, why, if this is such a good idea, why hasn't it, why isn't it more available, or is it becoming more available, I suppose is really the question.
I would say that revenue-based financing is beginning to become more understood, but it's just like everything else. I mean, there's been so many things that are adopted by other areas. This is one of those examples. I mean, when the guys went to space, there was lots of innovations that they used that eventually were beginning to use in a commercial market, be it microwaves, Tang, and all those other great products that eventually migrated to the commercial market. The internet, I mean, all of those pieces. And so it took time. I also think that there's been a recognition with the pandemic of understanding the whole issue of equity, that this isn't a new problem. Businesses led by diverse founders have been around for hundreds of years, but they've always had this issue of not having sufficient amount of capital. And there's more awareness made about this gap in equity and gap of access to capital. And the other factor is that by allowing for people with different lived experiences to look at other ways to underwrite these companies than the traditional way that's been used, that all of those things have been the convergence that has looked at there's another way of solving this problem.
Fantastic, thanks, Kim. Hang tight. We'll come back to you in a bit. We have some more questions, but we wanted to bring in Jonny Price. Jonny, Wefunder and perhaps you in particular has the crowdfunding market a buzz about community rounds, which is a bit of a reframing of crowdfunding. I think I saw on Twitter WNBA fans calling for a Wefunder-led community round to support the new expansion teams in the league. What are they and how are they changing startup funding?
Yeah, we recently tried to kind of rebrand the equity crowdfunding industry away from equity crowdfunding, which is a term that we've never really liked, and to just kind of reposition it as running a community round. Couple of reasons for that. I think one is, when you think of crowdfunding, you think of Kickstarter, right? Kickstarter's awesome, doing amazing work, and that's a great source of capital for a lot of entrepreneurs, right? Especially kind of creative entrepreneurs and artists and musicians and movie producers. Kickstarter's doing awesome work. Kiva's doing awesome work. When it comes to crowdfunding of microloans, the team that I used to lead, as you referenced earlier. And what we're doing at Wefunder, and there's other platforms as well, like Republic, that are doing kind of investment crowdfunding. But that word crowdfunding, it has the connotations of Kickstarter, and it's also like founders, I feel like, don't really want to raise from a crowd, right? That sounds a little impersonal. It doesn't sound prestigious. Whereas, every founder wants to build stronger ties with their community. And so just as you might run a friends and family round, just as you might run an angel round, so now we're trying to popularize this concept of running a community round where you're letting your customers and your community invest in you alongside VCs, alongside, kind of more conventional large check angel investors. We definitely don't see this as kind of, competitive to, I guess in a sense it's competitive, but it's not like a substitute for. Sometimes it can be. There are some founders on Wefunder that choose to raise all of their capital from their customers and community. But we're seeing more and more companies, Mercury is a good recent example, Replit, Levels, who are raising from VCs and are very well funded. They don't need the money. They're not raising $5 million on Wefunder because they need the money, but rather they think it's going to be an awesome way to delight their customers and engage their community. So a few weeks ago, we launched this website, communityround.com. Check it out. Some really cool case studies on there. And that's how we're trying to frame and position this industry moving forward.
Jonny, is this like part of, we've been positing this notion that there's kind of, a new capital market that's not necessarily, sort of dependent on, or even possibly even correlated with other capital markets, that you can bring in kind of whole new groups of funders at, much smaller dollar numbers, kind of the same way I guess campaign finance got disrupted by small dollar donors and, distributed everything now. Is this like, again, it's, I guess, same question to Kim. Can this become, not just a niche sort of edge of the market, but a whole new big, huge market?
Yeah, I think so. I mean, I kind of agree with Kim's answer on revenue-based financing kind of growing. For me, what we're doing here at Wefunder with community round concept is very new, right? And it's disrupting a paradigm that's been in place for about 80 years, right? So some context, the Securities Act of the 1930s basically prevented people from investing in private companies, early stage companies, unless they were accredited investors, right? And so basically 8% of the population are accredited, 92% of the population are unaccredited. And so until the Jobs Act passed Congress in 2012, and then the SEC took a few years to roll it out. So May 2016, the SEC rolled out regulation crowdfunding. And until then, 92% of the population couldn't invest in early stage startups. So they could invest. And when I say early stage startups, we're often talking about tech startups and Y Combinator and Techstars grads. But we're also talking about Chattanooga Football Club. Shout out to Jonathan Bragdon at Capacity, who's also doing some cool stuff in revenue-based financing. Saw him on the line. But Chattanooga Football Club raised 900 grand from 3,500 Chattanoogans to invest in that business. We've had breweries and restaurants, really cool restaurant called Cassava in San Francisco that raised $400,000 from her fans. So we're not just talking about tech startups here, we're talking about Main Street businesses as well. And so since 2016, 100% of the population has now been able to invest in early stage private businesses, coffee shops on Main Street. And until that point, any one of us could go and invest in Starbucks on the stock market, but we couldn't invest in our friend's coffee shop down the street from us. And from a mission perspective, that's what we're all about, is letting everyone participate in these investment opportunities, and also let the local coffee shop owner benefit from the capital that's in their network, in their community, as well as letting Howard Schultz benefit from that capital. Then we're just totally unlocking a massive amount of capital to now, for the first time, be able to invest in early stage startups, right? But we're in the early days of this, right? So 2016, the law changed. For the first 5 years, the laws were not particularly attractive to founders. So you could only raise $1 million per year. It was tricky to roll investors to one line in your cap table. You had to do some legal paperwork before you could launch. So the SEC rolled out some improvements to the rules in March of 2021. Now founders can raise $5 million per year. They can use a special purpose vehicle to roll investors to one line on the cap table, and you can spin up a page and start fundraising in a day. Previously, it was many weeks. And so, it's only been a year since these new laws have been live. We've seen significant growth during that time. For me, what we're doing is hard, is paradigm shifting, and it's probably, we're not going to get there overnight. But we definitely see trends that are super positive, that this movement of community rounds, just as with revenue-based financing, is gathering steam, and there's still a very, very large mountain to climb, but we see a lot of potential, looking into the years and even decades ahead.
Jonny, the structure, the technology is doing a great job changing who is able to invest. One of the things we've been tracking and excited about is it's also changing who gets funded. And pretty startlingly so. For example, last year, record amounts of crowdfunding raised, some to the tune of $500 million, I think, $500 million. Black and brown funders received roughly 1/3 of the total raised through online startup platforms. Similarly, for female founders, who get just 2% of venture capital, received almost 20% of crowdfunding capital. So that's that, and this is and to be fair, Kim and revenue-based finance Founders First has even better numbers in terms of demographics. So what is it about crowdfunding that is changing that?
Yeah, I think it's a pretty easy answer, right? Which is that if you look at who controls the purse strings today, if you look at like the demographic breakdown of VCs, for example, or angel investors, it's overwhelmingly white men on the coast, right? Silicon Valley, New York, and Boston account for 77% of venture capital dollars. And so I think, that's the reason why I would argue that's a big part of the reason why a lot of the capital historically has flown to white men in those geographies. And what Wefunder is all about, like, democratization is a buzzword, right? Sometimes it's kind of not maybe clear what that means. For us, I think it's quite clear what it means, right? Which is like in the who has the reins of power in terms of allocating dollars to fund, startup businesses. When we talk about democratizing that, we're saying the power shouldn't be concentrated in the hands of millionaires and VC funds. Everyone should democratically have a vote. Everyone should be able to vote with their dollars on which businesses in their communities or in cause areas that they care about get funded. And so if we're democratizing and lowering the barriers to entry and letting, creating millions and millions of new angel investors who are women of color in Tennessee, where I live, then we should be able to get more capital flowing to founders that look like them. And yeah, the results, I mean, I don't think we're at 50% of founders on Wefunder being women. I think there's still a long way to go, but certainly significantly outperforming kind of where the market's been. And we're committed as a company. We're a PBC and a B Corp, and we're committed to using this model, this democratic model, to try to level the playing field for founders who've been historically underrepresented.
That's fantastic, Jonny. And stick around. I want to get both of you on this question I was saying about the sort of new narrative for the economy. But let's bring in our ringers quickly. And what we have is one investor, impact investor, or actually more of you guys are investors, but and then three people who I think are as our sort of pattern recognition trend spotter folks. And so, but Ron Bohm of Boma Investments have been actually making investments from your family office, Boma Investments. So tell us about this inventory finance. Very simple, very direct, and I just think people should know how you think about it.
Okay, hello everyone. So to jump really quickly into it, because it's a short call, my wife Maris and I have been running businesses for 40 years, and we very much took the approach of what do people that are running businesses need. And that's pretty much along the lines that Kim was explaining, and I love the fact that she's founders first. That's been our parameter as well. If you look at how organizations often get funded, it's usually friends and family. 95% go that way. And we decided about 2008 that we would try to support scalable, positive impact organizations and make those people our friends. So we started basically asking people what do you need for the short term? And for a number of years, we did a lot of working capital. So whether it's solar or artisanal goods or medical devices inventory or whatever, we just helped, or hammocks in some cases. We help people bridge that gap between the time they have to pay for manufacturing or production and the time they actually got paid by their customers. So we did a lot of that, made many friends that way. I think overall we've probably done 50 companies, 100 some investments since 2008. And we kept getting asked, we want longer term capital. And we said, well, are you planning on flipping your company? Because that's the typical way of a venture firm looks at, or a venture investor looks at getting their money back. And most of them said, well, of course not. We're in this for the long term. So we kept saying no. So then we started saying, well, how do we stretch basically what was a 12-month loan for working capital into something that might be 4, 5, 6, 7, 8 years? And we started taking the same principles, which Kim described pretty well, monthly repayment up to an agreed multiple of the original investment, and you pay it back until you get to that cap, and you do it as a percent of revenue, where if you don't have any revenue in a month, you don't pay anything, but otherwise you pay the agreed percentage. A group of us, starting about 2014, started evolving that to see if we could make it a little more traditional in the finance area. And we came up with the one I think you want us to talk about, which is what we call, what the marketers in the group called performance aligned stock, but we called flexibly redeemable preferred stock, which means that you give somebody 100K, you agree to get, say, 200K back over 4 years based on a 5% of revenues paid on either monthly or quarterly. And as soon as you get to that 2X, you will be done. And they put it into a format which was more equity-like and made it a preferred stock, but they signed a redemption agreement right up front where you were able to get paid on a monthly basis exactly the same way, X%, but part of it would be a dividend and part of it would be a redemption. And they came into some really interesting little things, such as if the dividends that are being paid out are greater than retained earnings of the company, the investor can choose to consider that as a return of capital. So there's some pretty interesting things in that way. And one of the participants that worked on it, Womble Carlisle in New York, actually won an award around 2015, 16 from the NYU legal community for impact finance advancements. So it's been around for a while. It can be worked on a very large scale, or as we do it on a much smaller scale.
That's a great example of the kind of innovative financing mechanisms and also the sort of different levers you can pull and the tweaks on different fronts, whether it's tax treatment or other kinds of things. So thank you, Ron. Stick around again. Kevin Jones, are you with us? Kevin may not have joined, so let's roll on to Astrid Schultz from Zebras United. There you are. Popped up your video. How are you, Astrid?
Very well, thanks.
Zebras, in distinction, as everybody knows by now, to unicorns, and we sometimes think of it as revenues, not rounds, and it also seems to be in line with what we're talking about of real companies, building real businesses that may not be in the spotlight of sort of venture capital, mainstream venture capital. What are you finding about what the financing needs are, and are there any solutions that we haven't raised yet that could meet those needs?
Well, first of all, it's great to be with you all, and want to publicly thank Kim Folsom for coining the term zebra. And it's zebra, David, not zebra, because global. I think you used the term way before we popularized it about 5 years ago or so. And in a nutshell, I mean, what we're seeing is there's a need for patient and responsive early and growth stage capital, right? And the typical flavors of debt and VC don't work very well because you're either too early for the banks or you're not aggressive enough in your growth profile for VC. And so what we're excited about at Zebras Unite is really, obviously, the rise of crowdfunding platforms like our friends at Wefunder. We have a strategic partnership with Jonny and his team to sort of direct pipeline of our members to his platform. And we're also very excited about the development of new funds of the kind that Kim has built and that others are building. So I want to shout out to, I think Daisy, I saw you, Daisy Ford Downs, who heads up an innovative fund vehicle in Scotland, in addition to being our Edinburgh chapter lead. And I think Havel Rodriguez is here from New Majority Capital, who represents sort of both of whom represent sort of a class of capital innovators who themselves are zebras, right? So you're basically seeing a new sort of an explosion of fund models that are using debt and equity or hybrid or mezzanine structures to direct capital into this space, right? And so we're taking as one of our areas of work when we think about mobilizing capital, we think about mobilizing this new breed of fund manager and investor. We also see an interesting opportunity to leverage some, and I liked the point Kim made about how this is nothing new, right? The novelty is in applying it to underserved segments of the market and of society. And so by the same token, we're looking at things like the solidarity economy as it has existed for hundreds of years in the form of cooperatives and mutual aid organizations and financial mutuals and so on. And I'm thinking about working with, for example, the National Co-op Bank and some other partners on ways in which we can tap the sort of legacy co-op economy players and help them support the next generation of platform co-ops and the rest of them. And when I say cooperatives, I mean, you might think of your little corner food store co-op, but think about REI and Ace Hardware and of course Mondragon internationally. Those are some pretty large companies, right, who have been around for decades, if not hundreds of years, who you could imagine doing some sort of 1% for the people pledge with to help unlock new sources of capital into this, again, next generation of companies. And then thirdly, I mean, what we're seeing in terms of the need and opportunity for new sources and uses of capital is generally the appetite to just create our own, right? So there are innovators in other parts of the world outside the US, whether that's in Europe or I put a link to the Land for Good platform out of Australia into the chat from our friends at Red Hat Impact, who, for example, are doing interesting things like developing trade finance vehicles for small and growing businesses in Asia Pacific region, where again, we're tapping sort of existing and known vehicles like trade finance for these new demographics of entrepreneurs who happen to be women and typically underserved. So those are some 3 areas where we get very excited at Zebras Unite.
That's fantastic, Astrid. Thank you. And you touched on a couple things. So one, the explosion of not only Zebra-like companies, but also the structures, increasingly intermediaries and other structures and models. Also the international sort of source of a lot of this activity, or at least testing ground. I want to bring in Andrea Armeni from Transform Finance, who a few years ago did a fantastic report on these financial innovations in Latin America. So you all should check that out. But Andrea, I wanted to put to you the big question, which is, if all of this is such a good idea, why hasn't it become bigger than it is at the moment, and what may need to change?
Thanks, Dennis, and glad to be here. I always learn so much on these calls, and this time I already learned that it's zebra and not zebras, so I'll walk away happy. It's always something. So when we started looking at the structures for this report, we really thought that if, until it was back in 2014, 2015, that if there was some systematization of the models and socialization of them, they would get adopted widely, everybody would like it. And I will say that has not happened. So the interest has grown tremendously, a lot more chatter. We've seen more deals around revenue-based, kind of straight, let's say, revenue-based loans, but not really seen much in terms of demand dividend. We've seen a lot of interest now in kind of self-liquidating structures where there is a mandatory redemption of shares. So we thought that, yeah, the problem was almost a technical one of knowledge and conversion on certain term sheets. But when you look at, the terrific work that the Impact Terms project has done, some of the lawyers that really put blood, sweat, and tears in this, the knowledge is out there. So I think that there is still a problem of kind of patience, willingness of investors to try something new and put up with the additional diligence costs or legal and structuring costs. So honestly, I am a little bit disappointed that we haven't seen more. And if anything, and I'll put this back to the group perhaps, I'm still baffled by all the emphasis that there is in venture capital, given how it's applicable to such a small portion of the economy. And there's so much effort, say, in funding first-time VC fund managers that were historically underrepresented, which is great, right? And it's, as a matter of justice, is absolutely necessary. But why are we focusing so much on that VC funder side? I still don't quite get it. I wonder if a part of the issue, and that's one that we're actively looking at now with Donut Economics Action Lab and some other colleagues, including hopefully with Zebras Unite, the issue of how we can match the capital requirement to the alternatives on the structuring side of the enterprise itself. Right? So if you think of it, you have a desire for more alternative enterprise models coming out, whether it's steward ownership, purpose trusts, multi-stakeholder co-ops, and the like. And that should be probably where these alternative deal structures end up happening, right? But there hasn't been a matching up of the two things. So we want to kind of document where there is interesting activity there and where the two appetites can be matched, right? Maybe investors will be more excited about doing alternative deals if on the other side you have alternative ownership, alternative governance structures.
So,
thank you,
Jonny. I'm just sharing your good call to action here. I'm sorry. Around these alternative governance structures, which perhaps is, and Astrid, you mentioned that as well.
That does get to what we were saying, which is that it becomes a sort of parallel economy, right? Different kinds of structures getting funded by different kinds of structures, and you have sort of new players on both sides of it that may or may not have even been participating really in the previous market, and that market, as we were saying, could be 4 times as large as the 20% that's funded, as you said, by venture capital. Andrea, so you really could have something that's quite a bit of a new phenomena, and really change the trajectory of sort of who gets to build wealth and who gets to build companies. What maybe anybody here now, including the audience, what's a key a bit to flip to make something happen? What are other things out there that we should be focused on? Should we open it up a little bit, Dennis? I don't know what people are putting.
Yeah, I just have, my folks gather their thoughts. I just want to throw one question back to Kim, because Kim recently raised an $11 million Series A into the company to then deploy a credit facility of $100 million. So there's some real money. There's some institutional investors there. So Kim, I was wondering if you could just say who's upstream of Founders First.
Well, there are, but there are not many. And it is, to David's question, it is a difficult exercise to swim in both lanes. The credit evaluation, the infrastructure, the deal structure, it's the classic adoption issue, is that having people change their behavior from doing something that they know works, it's hard for them to do something different. We set up our structure such that not only did it, serve the needs of the entrepreneurial market that was grossly underserved, we also set up our platform to serve the needs of the impact investors that wanted transparency to see that if I fund this vehicle, it will have an impact and create jobs in this underserved market that I don't have any connections and all of that, but I know that I want to do something here, either in my country or in my state or in my community that may be 10 or 20 or 50 miles from where I live. And there's not been that level of connectivity before for some of the types of businesses that don't happen to have a predefined community or connections or family. I mean, there are many structural or systematic issues that underserved founders have. They don't happen to have the friends and family network to be able to provide them access to, $50 or $100 or $250,000 that many of the earlier stage companies that end up becoming venture financed, are able to grow and become the unicorn companies. But once they do get access to this capital, they can become the zebra companies that are, great job creators. And, a larger percentage of this country is reliant on jobs from those small and medium-sized businesses than they are on the large businesses. But the reason why this paradigm has a change is one, mindset shift. If you've been making money one way for all this time, it is hard for, folks that have been doing this for this long to change and be open to doing something differently. Secondly, with regards to this perception that if I do something differently, I'm not going to get as great a returns. These were the two battles that I faced with raising the money that we raised. And then the third has to do with the fact of once they see that, yeah, I could make this money, I could do it this different way, I don't want to go through all the complexity. There are people who are interested in it, but they do not want to do the work. The structure of the organization that we had to build is different than the structure of an equity fund where you can get, two guys that have known each other. They probably worked at a tech company before. They have a series of pools of funds. They make, 5-10 investments a year. And, it's a simple set it and forget it. But the challenge is there's not enough comfort and enough patience to allow for, if that first fund, which most often the case doesn't work out, that they will allow for funding the second and the third fund. That just has not happened. Every time, I've been around long enough to see that they fund the first one and the first one didn't give the returns. And it's like, see, I told you, you couldn't do this. So it doesn't work. And it can, if you have the patience to do it. It's just going through and having those convergent options, together.
Thanks, Kim. Judith, you have your hand up?
So quick question. So first of all, thank you for this dialogue. Thank you for this conversation. One other thing that I think is missing in this conversation, Kim, would love your reflection on the role of fintech. I advise small businesses, particularly run by women in the food sector. And one of the areas we've seen that's been really transformative during COVID was the way Square was able to actually, in terms of the alternative finance space, Square, because of the technology, because they know the way, they know more about the business's own finances than the business does. And they were able to actually, many of the businesses that I support and advise, look at how Square as a platform in the POS system are able to provide loan to sustain those businesses. Any thought and reflection on how, depending on the sector you're working with, where you're actually balancing your type of support versus something like a fintech, I'm using Square here as an example, would be providing to those businesses to actually potentially grow at scale?
Well, so our view on this is it's more than money that's going to take these companies to grow. So yes, and you have the opportunity to get additional capital at different areas, but capital alone won't help these companies scale. Many of these entrepreneurs are first-time entrepreneurs, and they need a supportive infrastructure that's going to help them grow to be that 7, 8, 9-figure businesses, just like what's happened in many of the tech environments. And it's not a one source of capital that meets all needs. As the company grows, there's going to be different capital needs that they're going to grow into to be able to manage, and it's building out that ecosystem. Some successful entrepreneurs have, done that and have learned from other people to make all of that happen. But it is feasible to, sources like Square, or PayPal, and even Amazon. I was at an event last week where a woman who had a $5 million company grew it to a $90 million company, and she did it largely using funds through Amazon. She was a CPG, consumer product goods provider, and because of her particular profile, she did not have any other source of capital to do this. So it is feasible to do it, but you have to surround yourself with an ecosystem of connections and solutions, and being able to pivot along the way to make all that happen.
It does point up, Judith and Kim, the entrance of new players that have data on the businesses, as has been said, and can extend credit, and that does tend to disrupt some of the traditional pathways. So it is sort of interesting, and at least at a competitive level. Should we bring in is it Vidita? Do I have that right?
Yes. Hi, thank you so much for the insights. My question is to Jonny. So traditionally, like you mentioned, equity investments weren't open for retail investors because they're high risk. I wonder, apart from the regulation, what is it that's enabling retail investors who are typically not as informed as a general VC would to take these high risk investments, and what might enable them to take them?
Yeah, that's a really good question. It's something we really wrestle with. We've tried over the years at Wefunder to implement a number of product improvements that try to educate retail investors and provide the right information in a digestible way for retail investors. One such example is that we have lead investors on Wefunder. So every deal that launches on Wefunder, there's the lead investor. Typically, they're putting in 5% of the round, something like that, and they're helping to negotiate the terms of the deal. And is it a SAFE or a convertible note? What's the valuation cap? Or is it, we do revenue share investment structures on Wefunder as well. So is it a revenue share? And if there's a sophisticated angel investor with sector experience that's putting in 50K of the $1 million rounds, then hopefully that's kind of giving confidence to the crowd of investors that are seeing that. Yeah, one thing that we try to do on Wefunder is to emphasize that like our tagline is not invest in startups to make a ton of money. Our tagline is invest in startups you love. And so we really, and we were saying this kind of before the call, like I get excited thinking about, if a restaurant is opening up, that's a pretty risky proposition for a conventional bank, let's say, or a lender to make a loan to that restaurateur. But if you break down that $100,000 loan into 1,000 increments of $100 each, and if that loan of $100 has, let's say, an 8% interest rate, but as well as getting the 8% interest rate return, you're also going to get a free appetizer every time you go to eat at the restaurant. David called it the or dividends model, as opposed to hors d'oeuvres. That you can kind of make your money back in free appetizers. And so the point I'm trying to get at is I think the motivations from retail investors investing $100 may look a little different and more nuanced sometimes than an institutional investor that's investing $1 million and very, very focused on the bottom line for their LPs. Like, and so that's not kind of the whole piece of the puzzle, but certainly kind of what we try to lead with in kind of how we brand it and position it on the Wefunder website.
Jonny,
it's a really great question.
I want to, on the community round side, I'd love for you to go a bit more into how venture firms have partnered or sort of blessed their portfolio companies to go out and do a community round. I just wanted to flag too, we covered this week, one of your competitors, Honeycomb, launched an interesting fund with Upstart Collab that allowed foundations, 3 or 4 foundations, to make loans alongside of the crowd in creative businesses, restaurants, and the like. So this idea that like the crowd is either like or a community is a risk mitigant, or is a validation, or is something to that other investor that's trying to do something similar.
Yeah, totally. Honeycomb are awesome, by the way. That Honeycomb's a similar regulation crowdfunding platform that's focused on Main Street businesses, and have a lot of respect for their team. But yeah, what's really cool about this is if you wind the clock back 2 years ago, every time I spoke to a VC, well, I wouldn't really speak to a VC because they just didn't give me the time of day, and you know, equity crowdfunding was seen as, you know, kind of not prestigious and a negative signal, et cetera. And so the tide has really turned. I would say it's already turned, but it's continuing to turn. And so now, you know, when I'm speaking to VCs, like they're seeing these companies that are, you know, successfully raising Series B from VCs, not just kind of seed, pre-seed, Series A, but even Series B as well, who are opening up an allocation of each round, not because they need the money, i.e. it's a negative signal that they can't raise from real investors, but that they just think it's going to do good things for their company to bring on this army of passionate brand ambassadors and loyal customers who are going to then spend more money with them than their competitors. And so now the conversations with VCs are like, you know, it's not just like it used to be maybe, oh, kind of if you're kind of not going to invest in a company, then send it to us and maybe we can help, you know, increase access to capital that they might otherwise not be able to get. But now it's like, no, the companies that you're investing in, let's talk to them about, you know, reserving an allocation to their customers, to your point, Dennis, because the VC is increasingly buying into our hypothesis that if this company can recruit a bunch of customers to invest in them, that's going to do good things for their revenue growth. And that's the vision for us, is that like in the future, right? Because right now, if you can raise $5 million, if you're a startup and you can raise 5 million from Wefunder or 5 million from Andreessen Horowitz, right? You're going to go with Andreessen Horowitz because, you know, the brand, and they're gonna help you and do all this kind of stuff for you, etc. We want to build it into a world where every startup founder, it's such a no-brainer that they would let their customers, they would open it up to democratically let their community invest in them, because they see so much value for their business growth in doing that. Don't think we're there yet, but that's the world that we're trying to build. And increasingly, we're seeing more founders and more VCs kind of resonate with that message. And if you kind of, another way to look at it is Web3, right? This whole kind of principle of Web3, kind of decentralized kind of stakeholder engagement, community ownership. It's a lot of similar principles to Web3. Web3 is kind of very focused on crypto as like the means of doing that. Wefunder, our CTO described Wefunder the other day as, you know, Web3 without the crypto. But I feel like these principles of community ownership are very, you know, kind of central to the zeitgeist right now.
We're going to come up on the top of the hour, and Youngbo, we're going to, as you know, we're going to stick around. But before we hit the end of the sort of official program, I want to give each of you a chance, and the ringers as well, to tell us how all of these mechanisms will fare in the current economic climate. And I don't want to characterize that for reasons that I said before, but where we're at now, and whether there's an opportunity to expand this because of where the economy is at. So if you could focus a little bit of a final thought for us, and then we'll open it up, and we'll Dennis and I will go on mute, and everybody can have at it.
Yeah, I can start there. I have a kind of a slightly interesting perspective on this. I think I'm speaking narrowly here about Wefunder, but obviously there's kind of macroeconomic concerns right now, and if you look at kind of early stage venture funding, I think there's a pretty widely held conviction that that's going to slow down in 2022. 2021, I think early stage VC deals were about twice what they were in 2020. And sorry, I know I'm saying VC here, Kim. You know, I think that's the asset class that I have data on. So there's probably kind of similar, you could say similar things. So Main Street businesses, revenue-based financing as well. But if VC slows down in 22, I predict, we'll see, but my prediction would be that for community rounds, what we're doing at Wefunder and other platforms as well, Honeycomb, Republic, that we would see an increase in investment volume in 2022, because if founders can easily raise from more conventional investors, then there's less of a need for them to raise capital from their customers and community. If in 2022, it's harder for founders to raise a seed round from angels and VCs, which it will be, then I think more founders who wouldn't have needed to go the Wefunder route in 2021 will go that route in 2022. And so I think we'll see more founders launching on the platform, and also kind of really high quality founders as well. And so I think I think that we're going to see that drive a significant acceleration of growth in community rounds in 2022. You guys should have me back on in a year's time and see if that prediction has come to pass.
Kim?
So, you know what, I would go through as I look at the, you know, what happened in the pandemic for diverse-led founders, which were hit, you know, 4 times as hard with regards to this. They will use their resiliency to pivot along the way and find ways to incrementally invest in their business so that they can get on the path of growth over that time, where everyone kind of had a shell shock and the March to April timeframe. For the most part, by the time it got to May, you know, there was incremental improvements in their performance once they, you know, pivoted to find those alternatives. I think that their view of, you know, many of these companies haven't had that path of going to VC alternatively when things have changed, or some of those things, or as Stacey Abrams has said, you know, for the majority of companies, this is like, you know, 75, 80% do not have that Shark Tank moment of going to someone and saying they're going to get a deal. So they're looking at alternative ways. And now there's something to be very supportive with helping them grow.
Thank you, Kim, and thank you, Jonny, and thank you, all the ringers. And let's open it up now. But we did see that Ani Patton Power has arrived after teaching class, who has written a book on this subject. And we tried to have on the call, but she was committed to her class. So Ani, if you want to come on and just say sort of, you know, or address some of the things that we've been talking about, which you don't know, but just sort of.
I think I have a pretty good idea. I think I can probably guess, Dennis.
Yeah, I mean, in terms of what you're seeing now, and I mean, maybe address it in sort of an international context in terms of the adoption of some of these mechanisms.
Yeah, it's really interesting. Thanks. Hi, everyone. I'm so sorry. I was so devastated not to be able to join, but I'm a good professor and I can't cancel class just because I want to do something else. But, you know, I think really what I'm seeing is quite interesting, Dennis, is, you know, even before the kind of everything that's happened the past couple of weeks is, even as VC was, you know, the media and investment darling, I was seeing more and more interest in alternatives to VC. I think it's, you know, the rise of the amount of capital that's available, and yet still the exclusionary and very biased allocation of that capital. It just didn't change, even though there was, you know, now $150 trillion of dry powder. People still saw the way that was allocated was to, you know, a very small set of founders that looked a certain way, that had a certain type of business. And so, you know, funders that I speak with, high net worths, family offices, large institutional organizations, foundations, are just, I think, really hungry for alternatives that allow them to allocate capital to organizations that are creating impact, that have, you know, a diverse set of founders, and that are looking to create sustainable businesses. So actually work we're doing right now with that's funded by the US government around redeemable equity and revenue-based financing and others is really looking at post-COVID recovery and plays into the administration's desire to be able to make sure that the recovery capital actually goes to a much broader set of organizations. So lots of people on this call are working on that project with us, also with Blueprint Local and others that are on here. And so I think that it's just, there's a hunger that I'm seeing on part of asset owners to be able to understand how they do how they do financing for small businesses that's risk capital that goes beyond VC. And so I think that it's interesting to me. I mean, now that we've had this market correction, we're going to have a whole different thing, but it was really interesting to me that I saw the interest in that increasing as VC became more prevalent. It's almost as it was more in the market. People started to realize the limitations of it. And I think that's a really interesting dichotomy.
Thank you. Yeah, I mean,
and also I wrote a book on it, so check out my book. It's hopefully useful.
Yangbo, you wanna hop in now? You got your hand up?
Yes, just several few points to bring up. So one is, and I've seen certain panelists and members of the audience alluding to this, that basically if you're going for any early stage investing, it's much more helpful, and not just for an investor, but definitely more so for ecosystem development, to treat it as an infinite game, and any games just be a byproduct. So first, any reflections, any observations on how have investors been approaching this? Like, do they approach it like a finite game, as often most other types of investing is? Or are you seeing more and more acknowledging that, yes, this is an infinite game? So that's one. And then secondly, because someone brought this up, Mary Christine, you did, a few others, is do you see much potential in additional financial innovation in this type of, and for early stage financing, since probably more than a few here have brought up and would be interested in using nature-based assets, nature-based finance as a way of deploying early stage capital. So putting through these different layers, so you could effectively, there's no shortage of ways to engineer this so that you can have things like carbon credits or such, or savings from natural hazard prevention or such things, be able to provide early stage liquidity, especially for community development purposes. So just overall, your thoughts on those themes, just infinite versus finite games in early stage investing, and financial innovations cutting across sectors.
I don't know if I'm alone, but the finite versus infinite, is that just saying, is there a cap to the return?
No, so the difference is finite would be that you're trying to earn something, you're trying to gain something, you're trying to win at the end. Whereas infinite means that you play the game to play the game, that if you win, it's just a byproduct, but that's not.
You're asking a more metaphysical intention question, not a narrow financial returns question.
I mean, yeah, exactly. And that's where so many trip over with early stage investing, is that when you're building an ecosystem, it's actually why there have been so many missteps you see time after time on starting a startup ecosystems, that so many who try to see the ecosystems top down, they try to treat it as a finite game, that we need to hit these metrics, we need to get these exits and such, whereas those that actually endure.
Let me, I don't know that this actually answers your question, but Ron Bohm, I know you have wanted to move the capital through your loans more quickly, so you could recycle it yet again into more companies. So maybe that is a version of, or an example of, an infinite game. You have any thoughts on the recycling of loan capital to maximize impact?
Yeah, we have two theories. One is time to impact, and time to I guess, how many turns do we have of our inventory of money? And we like the shorter term ones because almost everybody that isn't a software player or an app play needs working capital often for things. And if we can get that back really quickly, we can turn it to the next company. But also time to impact can be as short as 3 to 6 months as opposed to 6 years. So those are two theories that we apply to why we like the shorter term terms.
Yeah.
I don't think this is kind of a direct answer to the question there, but it kind of touches on both of those the questions tangentially, at least. What I mentioned earlier, that like one of the things I like about democracy, like a democratic approach to early stage investing, is that the power is decentralized, democratized, right? And so individual people have a vote, as in politics, that we have a democratic system, everyone has a vote, versus like an aristocratic kind of system. And so that's a benefit of democracy. Another thing I like about democracy is it allows for kind of plurality of voices, right? And so it goes back to kind of, I think it was Narita's question earlier about kind of retail investor sophistication and kind of their ability to kind of, figure out financial returns. Like I invested in Chattanooga Football Club. I invested $125. And I didn't look at the financials. I didn't care if I ever see any of that back. Now my name is on their soccer jersey, or like, we see mothers investing in their sons, or there's this company on Wefunder, Leah Labs, it's curing cancer in dogs. And you see so many of the notes on their page. It's like, oh, my dog died of cancer. I want to be a part of the solution here. And so when you have a democracy, like everyone gets to assert their own kind of risk or reward trade-offs or invest from their own motivation. So I don't know if that and then also, like when it comes to investment terms as well, we do revenue share-based deals on Wefunder. I would love to do more of the kind of the indie VC type model, if you guys know that, where it's like a hybrid between a safe and a rev share or profit share. Calm Company Fund has a similar instrument, shared earnings agreement that they popularized. So again, I think like when it's not kind of one monolithic fund, we can accommodate a number of different investment structures, and some I didn't understand the terminology or the nomenclature that the guy that asked the question was just putting out, like nature-based assets or nature-based kind of investment structures. I don't know too much about that, but we'd be certainly very open to considering that. And again, because it's a platform, it's a democratic platform, there's the opportunity for, I think, some weird and wonderful and exotic investment structures that we can put out there as a test. And we certainly, we've had an array of investment structures used on Wefunder over the last few years, and we would love to keep experimenting and trying new approaches there.
And Jonathan, you're from Chattanooga. You had something to add to just build out that case study, that test case.
I mean, you're asking me. I mean,
Did you invest in the football? Did you invest in the football
as well? And we also do. We also have a fund that we're doing something similar to Indie VC, where we're doing redeemable equity options that tries to do some non-dilutive capital as well, or at least less dilutive capital. Mainly, the big thing that we're trying to do at Capacity is trying to create optionality for the founder, so that usually a founder, when they're early stage, they don't really know if they're a rocket ship or a Main Street business. They could be either one. Either one of those could be successful, depending on your terms of success. And so, can you create a ladder through that path that really fits that company as they go? And maybe at some point you have a founder who is incredibly happy with 40% margins and 20% growth and owning the entire thing. Or maybe they realize they've got an equation to be a massive company and become a dragon and return somebody's fund, but early on, it's really difficult to do that, but we're forcing founders into those decisions really, really early. So crowdfunding really helps because you've got other return mechanisms around that.
Can I add something there? And I don't know, maybe Kim has already talked about this, but the other thing that I'm seeing, which is quite interesting, is the gender lens component to this. So I talked to a lot of female entrepreneurs that, to Jonathan's point, don't want to fit in to that bucket of having to have a VC on their back because, they want to be able to, be a mom or, do the things that they want to do. And I know it's not just for female founders, but I found it very interesting that in the conversations that I've had, that often the female entrepreneurs were the ones that were more willing to vocalize that. And to say, this is the type of company that I want to run, to be able to have that, not just lifestyle, Joan, but also like, I want to run a sustainable business that I'm working, 40 hours a week, not 120. I don't want to be, having to Jonathan's point, like having to be on that dragon path from the very beginning. Like maybe grow this to be a huge company, but I don't want to be responsible to investors for that. And I think that I know that both male and female entrepreneurs think that way, but I do think it's quite interesting that, that's one of the reasons women sometimes self-select out of VC and not going to raise VC funding. And in addition to being passed over for it. And I think we often talk about, oh, women aren't given VC funding because, they're not given it. And I think sometimes the thing to say is that sometimes some of these female founders are like, I don't want it. Like, I don't want to sit there and have to do 100% growth every single quarter for, the next 20 years. And I think that's kind of an interesting way to sometimes reframe it, is not that we need to make VC work for organizations, but, we really need to think about what type of capital actually makes sense for underlying entrepreneurs.
And to add to that also is the refugee and migration lens as well. Any comments on that?
I didn't have a comment with regards to that, but I would go through and say that, there are a lot of different types of businesses and because again, access to startup resources, there are many folks that start service-based businesses because it's an easier way of going through and doing that. And when they start a service business that can transition to be a tech-enabled business and so on and so forth, their options and pathways to be able to launch and grow those businesses are limiting. So that is a constraint. And many of, immigrant women, people of color that start businesses that have minimal resources, many of the times they're starting with their credit card. That is probably the only source of capital or their savings to be able to launch those businesses, and having a funding partner that won't penalize them because that's the journey that they took to launch a business. Many times we find service-based businesses that transition to be a tech business, and the first thing that they get is, okay, well, take 45% or 50% of your company because you did not start immediately as that path.
Did not start immediately as a tech business,
as a core tech business,
but evolved out of a service business. You're saying they get disadvantaged in the marketplace. Mm-hmm. Interesting. Yeah.
So can I add to what Ani was talking about? I think far too few people look ahead and see if there's an alignment between their own goals as founders or founding teams and the investors. I think probably 80-90% of the time, if you did have that discussion, you would eliminate the venture model. Because very few people I know, in fact, very few people I want to invest in to create impact are ones that want to flip the business. And often there is no exit unless you flip it. So if you don't have that discussion up front and know if there is an alignment between when the exit happens or how the exit happens, I think you're heading into some risky waters that most people ignore when they just jump into a venture model.
Definitely, and it seems like Andrea, you had plenty in the chat. If you mind elaborating on some of those.
Not really. No, I think I put it down there. It's probably enough. It's just like I keep going back to Dennis's question earlier about why we're not seeing more of this, and I appreciated what Ron said rather in his response to my earlier point. We have this extra layer of having to persuade the LPs into the fund if the fund is then going to do alternative deals. And we see less of that limitation, obviously, if we have direct deals. So I don't know if there is yet this education of LPs away from traditional VC funds that could be a good possibility here, or if it's like a really like a narrative change more broadly that is needed, right? To me, like capital is like fuel, and nobody would go around and be like, oh, I have a really big tank and I've filled it up with a ton of fuel. Okay, where the hell are you going? You know, and if the idea is that then you have to give them the car, then maybe that doesn't make sense. And that's where this idea of combining it with, you know, pre-purchase things, as Jonny was saying before, any sort of credits, any way in which you can start relying on revenue or future revenue instead of just getting more. Like nobody's giving you money at the VC level or at the big institutional level because they think you're cool or your idea is interesting, right? It's because they think they can make money off of it. So you're gonna give it back, and you're definitely gonna pay to give it back. Like that's all that there is to it. So I don't know why we're still kind of going in circles around some of the same stuff. Either we want to see this as a way of supporting impactful enterprises, or we want to make money regardless of whether we're going to kind of push those enterprises off track. That's kind of the two options. And less people that want to make money with it, but then we're not talking about, you know, capital as a way of supporting the enterprises. That's it.
So aligning the capital with the enterprises and bringing in the kind of backers like Jonny was talking about that actually have a stake in the real purpose and mission of those enterprises is not just sort of new form of capital, but it's a whole new form of governance, I think is kind of what you're getting to, Andre.
Yeah, can I add a slight twist actually? Because I was thinking about it when Jonny mentioned it before, and I remember when I was early on the Kiva platform, you know, thinking, oh, there's this, you know, cool lady in Tajikistan with 4 goats, awesome. And there was so much of an aesthetic judgment in what I was doing. And I guess it's good that I was giving money in that way rather than not giving it. But it was not tied to any kind of sense of real impact, right? There is a judgment that has to do with, you know, who has the best video on the platform or the catchiest, the coolest thing. Or yeah, if somebody does something for pets, like surely you're going to raise money these days. Is that where the money should flow? I don't know, and I think that that's a limitation that we should be thinking about as well.
Democracy has its own biases at some level.
Yeah. Several questions from the chat related to Africa, Southeast Asia, so really non-US, non-UK, just generally non-Anglosphere markets. So anything notable from those parts, at least from anyone who had been monitoring these markets, or even better, just insights that we here in the Anglosphere could be learning from these places?
I work mostly in emerging markets. So, I mean, other than some of the work that I do in the States, but particularly in Africa. And then I'm going to have to hop off because it's now almost 9 o'clock at night here. But I would say that, you know, I think actually what's interesting is that there's been a lot of these more alternative structures being used in Africa than people realize. So for instance, you know, things like trade finance and purchase order financing, supply chain financing being used regularly, types of mezzanine debt, venture debt that may not be called that, but whereby funders have, you know, had to go into small markets that aren't going to see IPOs and find ways to provide risk capital to underlying organizations. And so in some ways, even though, you know, we often think about capital markets in, you know, some emerging markets being obviously less developed, in some ways that's for some interesting private capital innovation. And yeah, as you just said, cooperative financing, Islamic financing, these are things that have been done for years, decades. And so in some cases it's unearthing it as opposed to necessarily introducing new types of capital structures. And so I think that there's actually a lot to learn from how do you invest in countries that don't see an IPO as the logical progression for a startup. How do you do startup capital? And I think that yeah, I just think that there's actually a lot more going on here than people realize, and so there's a lot to learn from some of those adaptations. So
Well,
And with
thank you,
that,
Ani.
I'm going to jump off. Thanks for letting me jump in at the last minute. I
Thank
signed on
you.
to see. I
Thank
didn't know
you.
if it'd be still here. I was like, oh, I'm hoping it's still there. I hated to miss the first part.
The party's still going, but I think that maybe we've reached the end of the party for today, at least. And I just want to say that I think, just to pick up on what Ani's saying, that there is this emerging pattern. I mean, we've seeing it now coming from different directions and different marketplaces and different domains, different industries. One of these things that I think is not yet kind of broken out, maybe broadly, but has a kind of logic to it that we'll see more. So I think this is one of those disruptions that when we look back, we'll see that it maybe already happened, and now we'll scale it up, and we'll be watching for all those clues. And we hope that you all send us your examples and your data points. But with that, let's let everybody go back to their other work. And thank you all again for your impact. We'll see you next time.
Thank you.
Thanks,
everyone.
guys.